2026 to May 2027. Lockups expire. Insiders can finally dump trillions in shares. They are the exit strategy. Imagine you're the world's unluckiest investor, buying stocks only at the absolute highest peaks when everything feels overpriced. Everyone thinks you're doomed, but real historical data is about to completely shock you. On the other side, we have an investor holding tight to a giant sack of cash, waiting patiently for a massive market crash or correction to buy cheap. Intuitively, it seems like she wins, right? Wrong. Then there's the third person, terrified of losing money, locking cash in a vault. We know how this ends. Inflation quietly eats their purchase single year. But is buying the peak truly worse than waiting? To find out, researchers at the Archbridge Family Office scanned the entire real data of the S&P 500 all the way back to 1990, putting these exact investment strategies head-to-head in a brutal. The results completely stunned Wall Street. Investing immediately at an all-time high actually beats waiting for a 10% dip, and even outperforms buying on random days. It sounds back, the math doesn't lie. This happens because all-time highs don't occur in isolation. They cluster during massive bull markets, driven by strong corporate earnings and heavy economic expansion. One peak usually triggers a dozen more right after. Meanwhile, the investor waiting for a dip sits in cold cash, while the market skyrockets. Sometimes that 10% pullback never comes, or it strikes years later when prices are already way higher than before. This is the massive hidden cost of waiting. It feels completely safe, but it destroys your compounding and dividend reinvestments over time. Investing is like planting a tree. Just plant it and give it time. Even if you buy right before a major crash like 2000 or 2008, investing a fixed amount consistently every gives your portfolio decades to recover and compound the inevitable market cycles successfully. According to Hartford Funds research, missing just the 10 best days in a 20-year period cuts your total returns in half. Miss the 20 best days, and 70% of your wealth is gone instantly. This proves that consistency beats perfection every single time. Regularly invest fixed amount regardless of market conditions completely removes dangerous emotions and anxiety from your long-term strategy. But watch out! Rockefeller Capital highlights a massive new danger. Today's S&P 500 is tech's 41%, mimicking the dot-com bubble. If these giants stumble, the whole index collapses. To survive this hidden concentration risk and protect your hard-earned wealth, I've mapped out an advanced portfolio shield strategy video. Click the exact video on your screen right now before it's too late. Subscribe and like for more institutional-level data insights. Now, drop a comment below right now. Are you deploying your cash today, or are you still trapped waiting for the dip? Let me know immediately.